Welcome back to the Deep Dive. We've been digging through the notes you shared on Domo's Q1 Fiscal 2026 earnings call.
Yeah.
And honestly, there's a pretty compelling story shaping up.
Absolutely. So the mission today is, cut through the usual commentary, pull out what's really significant from that call.
Okay.
And what jumps out right away, the results. They were strong. Beat guidance on revenue, EPS, and importantly, billings too.
And maybe even bigger news. They hit some major milestones this quarter, didn't they?
They really did. First time ever getting a positive operating margin in Q1.
Wow.
And also the first time generating positive adjusted free cash flow. Those are, they're pretty big indicators. Shows real operating leverage starting to kick in.
Right. And management seemed pretty bullish about it. They raised the full year guidance.
Exactly. They sounded, genuinely confident that those big strategic shifts they've been making.
The consumption model.
Yeah.
The partner ecosystem.
Yeah, that stuff. They seem convinced it's definitively working now and really setting them up for profitable growth ahead.
Okay, so let's unpack this for you. We'll dive into the actual numbers driving that confidence, look at the AI and partner strategies, and sort of piece together where Domo might be heading.
Sounds good. So starting at the top, revenue, $80.1 million. Billings, $63.9 million, both beats, like we said.
And the EPS.
Non-GAAP EPS was technically a loss, 9 cents per share. But again, the story isn't just the loss figure itself.
It's hitting those profitability milestones sooner than expected.
Exactly. Ahead of schedule. That's the key takeaway there.
Now, something that often leads the way for subscription businesses, RPO looked interesting.
Yeah, remaining performance obligations. That really stood out. Total RPO up 24% year over year.
Which is a big jump, right? Wasn't it like 14% last quarter?
Precisely. Huge acceleration. And the long-term subscription RPO, so contracts further out, up an impressive 61%.
61%. Okay.
What's really telling about that accelerating RPO growth is, it suggests customers are signing longer deals, deeper commitments.
Right. Management pointed to that as a sign of growing trust.
They did. And beyond RPO, there's subscription TCV, total contract value. That was up 69% year over year. Put those two together. It's a powerful signal.
And signing bigger, longer deals goes hand in hand with keeping the customers you have, right? Retention looked better.
Clearly improving. Net retention, that includes the upsells and downgrades, it was up sequentially again. Third quarter in a row, hit 94%.
94. That's a decent jump year over year, too. More than 4 points.
Mm-hmm. And gross retention, just keeping the revenue from existing customers, also ticked up. 86% now versus 85% last quarter and 83% a year ago.
So they're making progress on that front.
They are. Management explicitly said they're aiming to improve gross retention by 2 full percentage points this fiscal year compared to last.
And that's tied to the consumption pricing.
Very strongly linked, according to them. Consumption customers, they now make up, over 70% of ARR?
Yeah, annual recurring revenue.
And they expect that to climb higher, maybe towards 90% by the end of the year?
90%.
And the key point. The gross retention for those consumption customers in Q1 was significantly higher than for the old seat-based ones.
Okay, so this raises a question for you listening. How does shifting to this consumption model actually drive efficiency and retention?
Well, on the efficiency side, Salesforce productivity jumped over 60% year over year.
Also the third quarter in a row for that metric improving?
Yeah. Management linked that partly to getting leverage from partners, which we'll get to, but also just the efficiency of keeping customers.
Right. It's always cheaper to keep than acquire.
Especially with a consumption model. If a customer is happy and using more, expanding their usage, that's much more cost effective than chasing a brand new logo.
And how does it help keep them? The retention part.
So the idea is it drives stickiness. As customers use Domo more broadly, maybe across different teams, without that friction of adding individual seats.
Like a paywall.
Exactly. It removes those paywalls. So it gets more embedded in their workflows. It makes it easier for them to try out the whole platform, including the newer AI stuff.
So they can just experiment more easily, roll it out wider.
Precisely. Which naturally increases usage over time, makes the platform stickier, harder to rip out.
Okay, this is where it gets really interesting, beyond just the core numbers. The call highlighted some key strategic things fueling this. First up, getting customers to adopt more advanced features. AI agents, governance, workflows.
Yeah, and this wasn't just, aspirational talk. They gave some solid examples.
Wow.
Like a big global tech firm using Domo for massive data integration, plus an AI-enhanced platform, apparently boosting decisions for over 100,000 people.
100,000.
Or Filevine, that legal tech company.
Yeah.
They use Domo everywhere to power their analytics. Their CEO actually said their own retention rate went from over 95% to nearly 100% when Domo's integrated.
Wow, that's a strong endorsement.
And they launched something called Agent Catalyst at their user conference, DOMO Paloosa.
Right, aimed at helping people build AI agents quickly using their existing Domo data.
Yeah, and the demand was apparently huge. Over 200 customers signed up on day one for some kind of free AI solution build offer.
So people are definitely interested in the AI angle.
It seems so. And real-world uses are popping up fast. They mentioned agents helping detect anomalies at solar farms,
Okay.
reducing school dropout rates, streamlining charity tax processing, optimizing hotel performance, redefining inventory and sales management processes.
So pretty diverse applications.
Very. They even talked about consultants building powerful agents in under 2 weeks. Shows the speed you get when the data is already organized in Domo.
And that speed, building agents in minutes or hours sometimes, that's because the data is already clean and governed inside Domo, right?
That's the key advantage they stressed. And critically, for their model, using these AI agents, it drives consumption.
Because it uses credits under the consumption plan.
Exactly. It aligns value for the customer getting AI insights directly with revenue for Domo credit usage. It's a neat alignment.
Okay, what about the ecosystem? The partners?
Big improvements there too, especially with the cloud data warehouse partners, Snowflake, Databricks, Oracle, Google, the big names.
Where companies are storing all their data these days.
Right, and Domo sitting on top, integrating with them is crucial. The partner metrics they shared looked really encouraging.
Like what?
Well, partner source deals are apparently converting at much higher rates than their traditional marketing leads.
Okay, that's significant.
And the early stage partner pipeline is exploding. Leads and deals moving way faster through the funnel, up over 200% last quarter from just one partner relationship, they said.
200% from one partner. Wow.
Management has a pretty bold vision here. They think partners could eventually generate as much new business, new logos as all other marketing combined.
That's ambitious.
It is. They specifically called out success with system integrators tied to these CDWs and also their Domo Everywhere product for secure data sharing.
Did they give examples of wins driven by this whole picture platform, AI consumption partners?
Yeah, a few interesting ones. The geospatial company apparently chose Domo after a failed Microsoft Fabric project.
Oh, interesting.
Specifically citing the value of Domo's AML and ProCode features. Another one, a mortgage company, picked Domo for company-wide analytics, partly because of the unlimited users under the consumption model, helped them get past limitations of their old systems.
So the model flexibility is a selling point.
Seems like it. And they saw big upsells, too. A transportation tech firm expanded their deal 10x after a successful start.
10 times.
Yeah, scaled to 600 users under consumption after they made an acquisition. And a healthcare company expanded for a big deployment, leveraging that full platform access and unlimited licenses again. These stories show how the model helps customers quickly scale up once they see the value.
And they also mentioned getting good reviews, top spots in industry reports.
Right, reinforcing that analysts are noticing the tech and the model seem to be working better now.
Okay, so pulling this all together, strong Q1 metrics, these strategic initiatives gaining traction. What does it mean for the outlook? You mentioned they raised guidance.
They did. Felt confident enough based on Q1 and these underlying trends to raise the full year targets for billings, revenue, and non-GAAP net loss per share.
So for Q2, the current quarter.
Guidance is the billings between $69 and $70 million. That's modest year-over-year growth, maybe 1% to 2%. But remember that RPO growth we talked about.
Right, that sets up future revenue.
Exactly. Revenue guidance for Q2 is $77.5 to $78.5 million, and non-GAAP net loss per share between 3 and 7 cents.
In the full year.
They're now looking for billings of $312 to $322 million, app revenue $312 to $320 million, and a non-GAAP net loss per share between 18 and 26 cents for the full fiscal year.
And they stuck to those longer term targets, right? The exit rates for this year and next.
Yep, reiterated those. Exit FY26 at 5% billings growth and 5% operating margin, and exit FY27 at 10% billings growth and 10% operating margin. Right. Achieving that, they believe, puts them solidly into that rule of 40 category.
Where growth plus profit margin equals 40 or more. seen as a sign of a healthy SaaS business.
Exactly. Signaling that path to sustainable, profitable growth.
What up margins right now? Gross margin.
Non-GAAP subscription gross margin actually improved sequentially to 81.6%. They expect to kind of hold around there near term, but see potential for it to improve over time.
And the consumption model helps there too, aligning revenue with usage costs.
That's the idea. It could support margin expansion down the line.
How do they characterize the overall macro environment? Still tough out there.
They acknowledged it's not exactly booming, but they feel their team is executing well despite that environment.
Okay.
They see customer interest in data, especially for AI, as a positive driver. Customers are definitely still cautious, maybe more than 5 years ago, but they didn't feel that hesitancy got significantly worse in the past year.
And those CDW partnerships, are they mostly helping with smaller customers or enterprise?
Seems like enterprise is a big focus there. A good chunk of the partner-sourced leads are apparently from large enterprises.
So that's a way to expand their footprint in bigger companies.
Looks like a real opportunity. These enterprise customers working with CDW partners are often focused on getting data into their cloud data lakes, optimizing ETL.
Extract, transform, load, moving data.
Right. And that's where Domo's connector base and system can really shine, according to management.
And getting in via partners often means the CIO's office is involved. Makes the deal stickier.
That's a key point they made. It gives Domo a stronger, more defensible position in those accounts. Plus, being able to connect to multiple CDWs is seen as a positive by CIOs dealing with complex multi-cloud setups.
How are they balancing investing for that growth versus hitting those margin targets? It's always a trade-off.
Always a trade-off, yeah. But they feel they have the right investments in place now, especially riding the momentum from those CDW partners, while still kind of steadily managing costs to expand margins towards those 5% and then 10% targets over the next couple of years.
And just quickly on consumption pricing again, when contracts renew, how does that work? Do prices just go up?
The goal, they said, is aligning value and payment. So as customers get more value, more use cases, more data sources, using AI agents, their usage naturally goes up, driving consumption.
Right.
Then Domo works with them to ensure they get like a better rate per unit as their total usage increases. So it's meant to be a win-win, more value, more usage, better overall rate.
And like you said before, it removes that friction of adding seats.
Makes it much easier for customers to just adopt the whole platform more broadly, try things like AI with minimal initial costs before committing fully. That seems key to driving that platform adoption they keep talking about.
Okay, so based on everything we've discussed, the strong Q1 numbers, the raised guidance, these strategic pillars like consumption, AI, and especially those CDW partnerships really showing traction, we can maybe brainstorm some potential future scenarios here.
Yeah, for sure. And let's just state this very clearly. This next part is purely for discussion, for analysis, based on what was said on the call. It is absolutely not financial advice.
Definitely not financial advice. We're just thinking through the implications of these trends you've heard about.
Okay.
So here's maybe an outrageous but plausible thought. Think of it like a pitch you might hear tossed around an investment committee meeting.
All right, let's hear it.
Given that Salesforce productivity is up over 60% year over year.
Yeah, huge number.
And management's suggesting partner deals could eventually match all other marketing combined. Maybe, just maybe, the current guidance, even though it was raised, might still be underestimating the operating leverage potential here.
Okay, so the pitch would be?
The pitch. Go long Domo. Make a bet that this acceleration in RPO growth, combined with the steady improvement in retention,
driven by those stickier consumption customers using more AI.
Exactly. Fueled by that AI agent adoption driving usage and leveraged through that booming CDW partner pipeline, that all this translates into a faster acceleration towards those FY27 targets to 10% growth, 10% margin.
Faster than the market currently expects, faster than even the reiterated timeline implies.
Right. And if they hit that robust rule of 40 status ahead of schedule, maybe that justifies a significant re-rating, a multiple expansion as the market finally goes, okay, this transformation actually worked and sooner than we thought.
Interesting. Plausible, given the momentum metrics, but definitely relies on that partner leverage really scaling dramatically and the AI adoption continuing to directly drive consumption significantly.
It's a bet on the execution continuing at this pace or even accelerating. So just recap the main takeaways from the call for you. Domo beat across the board in Q1.
Hit key profitability milestones like positive Q1 operating margin and positive adjusted free cash flow ahead of schedule.
And pointed to really strong underlying metrics accelerating RPO, better retention, higher sales productivity, as proof that the strategic shift is working.
Yeah, the call really hammered home the message that the transformation plan, consumption pricing, ecosystem focus, AI integration is now, demonstrably bearing fruit. It's not just theory anymore.
So we really encourage you to think about how these specific trends we've unpacked might play out. That clear link between consumption and retention, the real examples of AI driving value in usage, and the leverage they're getting from partners like CDW providers.
How might those factors influence Domo's path forward from here? What possibilities does that open up in your own analysis?
Lots to think about there.
Definitely. Well, thank you for joining us for this deep dive into the Domo Q1 FY26 earnings call material you shared. We hope this breakdown gives you a clear picture of the moving parts and where things might be headed.